Chapter 15, Part 3, we're now going to look at finance sales type leases with guaranteed residual value. Now, residual value. The leasee guaranteed residual value of the leased property is an estimate of what its commercial value will be at the end of a lease term. Benefits include reduced risk to the leaser, incentives for the leasee to exercise care in maintaining and preserving the assets. Residual value affects several aspects of lease accounting, including size of the periodic lease payments, classification of the lease, amounts recorded by the leasee and lessor. Now we'll look at a problem. My company leased equipment on January 1st from Danny Company for 4 years with payments at the end of each year of $200,000, with the first year due December 31st. My company guaranteed a residual value of $340,000. The economic life of the equipment is 5 years and has an estimated residual value of $300,000. The interest charged by the borrower is 5%. The equipment cost Danny $956,000. Since the lease period is 4/5 or 80%, this is a finance lease for the leasee and a sales type lease or without profit for the lessor. Now, first, determine the present value of the lease payments plus guaranteed residual value for the leasee. Period is 4, because it's 4 years, annual, and the interest is 5%. The present value of annuity, since the payment is at the end of the period, we do our annuity, not the annuity due. We take our present value factor times the lease payments. Since first payment is at the end of the period, again, we're using present value of an annuity. And the present value of the excess over what the value will be at the end of its life, which is $40,000, times the present value factor of a lump sum. So the present value of the lease payments and excess for leasee. Determine the present value of the lease payments plus total guaranteed residual value for the lessor. The total would be different from the lessor because of the residual value of $300,000 and the excess guaranteed residual value of $40,000. So we would take the present value of an annuity like we did above, those numbers are the same. We then take the present value of the $300,000 plus the $340,000. So the present value of the lease payments and excess is $988,908. When determining what type of sales lease, we compare the cost of $956 to the present value of the lease payments, which is $709 plus the residual value of $246,810, which gives us $956. So the cost equals the present value. So this is a sales type lease with no profit. Now, here is an amortization table. So every time a $200,000 payment is paid by the leasee, they're going to record interest expense for the first one. The portion is going to be $37,105, and the amount that reduces the lease liability will be $162,895. And each time you go to figure that out, you're going to take the balance in the account times the interest rate, and that will tell you how much is going to be the interest expense. So the last payment should be the $40,000 for the guarantee. Now for the lessor, what we're going to do is we're going to show $300,000 as the ending balance, which would then be transferred back into equipment. Now let's take a look at what our journal entries would look like. So beginning of the lease, it would be for the leasee, it would be a right of use asset, lease payable. The first payment would be cash. Interest would be the balance in the account, which is the amount that we booked in the right of lease, or actually be the balance in the lease payable account, and lease payable. And we would amortize the right of use, which would be the $742,098 would be at the end of the year divided by 4. Second payment. Now, if you notice, the interest rate has gone down, more goes toward the lease payable. and we amortize. And here would be our third payment. Now, what does it look like on the side of the lessor? Well, the beginning of the lease, we would have lease receivable, equipment, and deferred revenue, which would be the net present value of that excess of $40,000. So we would go ahead and show our lease payments, which, if you notice, the interest revenue is different. And we would go, there's no depreciation because the equipment has been taken off the books. Now let's take a look at the final payment. For the lessee, it would be lease payable, interest expense, cash, and our last amortization, right of use, which would bring that account down to zero, and then lease payable would be taken to zero. And we're assuming they had to pay the $40,000 difference. Now for the lessor, it would be cash, interest revenue, lease payable, cash $40,000, equipment $300,000, lease receivable was $340,000, and the deferred revenue would be taken off the books and we'd book the revenue. So what we're doing for the last payment for the lessor is we're putting the equipment back on the books at $300,000. That ends the presentation for part 3 of chapter 15.